Hi, I'm Tom Lydon with ETF Trends here in Chicago at the Morningstar Investment Conference. Here with Ed Rosenberg, who's Senior Vice President, Head of ETFs for American Century. Great to see you, Ed.
Thanks for having me, Tom.
So we're at the beginning of another great conference. It's intermingling both mutual funds and ETFs for the first time. A lot of credibility to ETFs. We've had a huge evolution and a lot of flows over the last 25 years.
We have. ETFs have grown dramatically. 4 trillion worldwide, and they just keep growing. This year alone, the inflows have been over 100 million, and I would expect to see that to grow and not stop that process. Within the next 5 to 10 years, I would even expect to see, actually 5 years I would say, expect to see about 10 trillion in assets in ETFs.
More than double from where we are here.
Yes.
Yeah. What would be the biggest growth factors?
I think it's just the expansion of ETFs, number one, the types of ETFs. They're getting more and more similar to what mutual funds do today. As soon as non-transparent active comes into play, then you have every set of structure, in a sense, in ETFs that mimics what mutual funds can do today.
It's starting to show up already. We've got some issuers that are offering up transparent active ETFs.
Absolutely.
But we still have an emotional hurdle to overcome.
We do. When you look at the transparent active space, what's dominant today is the fixed income, right? And I think you're going to see that trend continue for a while. But if you offer alpha generating strategies in a transparent active equity space, you're seeing those assets grow. And you're seeing firms gather assets in a quick way in that structure.
So it's not been a great period of time for active. We've had a 30-year bull market in bonds, a 9-year bull market in stocks. Is that trend going to continue on forever, or might there be a time when active has its advantages?
I think what you're going to see is in periods of volatility like we're in, active does have its advantages because it can shift faster than an index fund. If we go into a downward market, now I hope we don't go into something like 2008, but if you go into a straight downward market, those index funds are fully invested. And you're going to see those assets drop, whereas the active managers can alter their strategy, go into cash, do other things to potentially halt that fall.
I know at American Century this is something you're paying a lot of attention to.
Yes.
And we hope to, in the coming months, see you in the space as well.
We'll be there. When non-transparent active comes, we're going to be there as soon as we can.
Well, as always, great seeing you, Ed.
Great seeing you. Thank you.
Thank you.